Hello, this is Anthony and welcome to Property MetriX. In today's video, I'm going to answer the very important question of should you be buying property right now? Because I know in the current market, it's property sales are a bit slow. There's high interest rates, affordability is a bit constrained again due to these high interest rates because the higher rates are, that means the more money you need to earn to be able to qualify for mortgages, etc. Because the mortgage cost is going to be higher relative to your income. So I know when we look at these kind of economic conditions and this economic backdrop, a lot of first-time buyers are a bit scared and they are avoiding the purchasing decision until next year. Where we have seen a bit of activity pick up in the market is with regard to first-time buyers buying a property over £300,000 because effectively they're trying to front run the reduction in the 0% stamp duty threshold from 425,000 to 300,000 pounds coming in after the 1st of April. But in general, should first-time buyers be buying property now? And the answer to that question is firmly yes. And I'm going to use some data to explain why I think all first-time buyers should be buying now. But the first thing I'd like to say is, why do I think first-time buyers should be active in the property right now? Because right now we're in a buyer's market. And what I mean by that is the buyers, the people with the money buying property, have more power right now than sellers because there's a lot more sellers than buyers. Right now, there's not much demand for property. There's not much people being active in the property market. So what you find is sellers are competing for a shrinking pool of potential buyers. So in order to get their home sold, they're having to negotiate price reductions. Right now you could be offering a 10 to 15% below market value offer and get that accepted by sellers. Don't be surprised. As well as that, sellers are aware of the recent autumn budget changes that's also softened the property market. So sellers are having to adjust for this and are willing to negotiate prices with potential buyers. So where you have a situation like this where there's more sellers than buyers, the principles of supply and demand says if there's more supply than demand, then prices go down. As you're seeing in the UK property market right now, a lot of prices are basically trickling down because there's a lot more supply, sellers, than buyers. So the sellers in the market right now have to price their properties competitively to attract the shrinking pool of buyers in the market. But as a first-time buyer, you need to capitalize on markets like this. Don't be like most buyers when markets are this attractive and this nice and there's discounts and they can buy below market value properties. Nobody wants to buy. Everybody's scared. They're waiting until rates go down. They're waiting until there's more activity in the market. They're waiting until their favorite news website tells them it's a booming market, it's time to buy. That's not when you buy. Right now is the time to buy. You buy when no one else wants to buy. You buy when the markets are a bit quiet, are a bit shaky. This is where the best deals are to be had. Because if you wait until next year, when interest rates are potentially lower, when there's a bit more optimism towards the property market, you're likely to be buying your first home at a higher price, and also you have less choice. That's another thing that people don't really think about when buying property. Think of it this way. Let me give you an example. So you're a first-time buyer and you're active in the market right now. There's a lot of properties being sold. So you know what that means? It means you have choice. You can find the property you want at the price you want because there is a lot more sellers than there is of you, which is buyers. But when that equation eventually does change and flip, when there are more buyers than sellers, then you know that property you like, by the time you go to view it, 10 people have already made an offer on it. So you won't be able to find your dream home anymore. You just be having to buy any home you can find because there's just going to be a frenzy where you're like, I just need to buy something, I need to buy something. Anything on the market, anything that's available, I just need to buy. So you're just going to find yourself literally just throwing your money, throwing yourself at anything that's available to buy. So why not buy now when all the odds are in your favor? You've got lots of choice. You've got a buyer's market so you can negotiate better offers. Why not buy now? But if that didn't convince you, I'm going to show you some data, some very powerful data that really drive home the point I'm trying to make, that buying now is better than waiting to buy property because in the long run, UK property prices generally increase, and when they increase, they increase. So I'm going to run you through some data right now to show you that the further you delay the purchasing decision, the more you're going to be paying for property, and the the higher likelihood that when you are ready to buy, you could be buying when it's unaffordable to you. So when I walk you through this data, hopefully that will show you and really hammer home what I'm trying to say, which is now is the time to buy first-time buyers. Now is not the time to be fearful. Now is not the time to wait because some media place said this is not the time to buy property market slow and all that rubbish. Buy now. Okay? I'll walk you through the data. So why do I think now is the best time to be buying property? So at Property MetriX, we've done some vast research into UK property market and done some models to see where we think the average prices of property across the UK in our various regions could be by say 2030, 2040, 2050. So using data from Nationwide, so the average property prices you see here in column C is data from Nationwide in their latest Q3 2024 average UK property prices update. So we can see here the average property price in London, according to Nationwide at the end of Q4, was £524,685. So what we've done at Property MetriX is we've said using 2024 as a base year, we've added a 4.1% growth multiplier. So that's saying what would property prices be if prices continue to grow at 4.1% a year, which is actually the average growth rate of UK properties from Q3 2014 to Q3 2024. So over the last 10 years, property in the UK has been growing about 4.1% a year. So if you look at the model here, so if London prices or the price of property in London continues to grow at the recent growth rate, based on the average price today of £524,685, by 2030, the average property in London will be worth £667,734. You extrapolate to 2040, you're talking just shy of £1 million for the average property in London, and we're at about 1.5 million in 2050. And if you look across the board, just look at the UK average, for example, then. So the average UK property price now, so that's across the whole of the UK, is, let's just call that £267,000. That's expected to grow to £339,000 by 2030 and £507 by £507,000 by 2040 and £758,000 by 2050. So the longer you delay your purchase as a first-time buyer, the higher you are going to be spending on property. So why wait? Why wait to buy a property? So let's say if you're a buyer in London, why wait until £667,000 in 2030 when you could buy it now for £525,000? Doesn't really make much sense. So let's say if you're even a buyer in, say, the Northwest, why wait until the average property is worth £275,000 to buy when you could buy it today at £16,000? And I want to also bring something to your attention. So I was recently reading an article in Property Industry Eye. So let me bring up that article for you to see now. This article here, and it's from a very reputable estate agent in the UK, Knight Frank, and this is their forecast on what they think will happen to UK prices over the next 5 years. So if you look at Knight Frank, they believe the average UK property prices will increase by, on average, say 19.3% over the next 5 years. So let's model that and see what that looks like as an annualized growth rate. So equals 19.3 divided by 5. So what Knight Frank is saying is they expect the average UK property to increase by 3.8% a year over the next 5 years. So just shy of the 4.1% I've modeled in this forecast. But I believe the forecast from Knight Frank are wrong, very, very wrong, and it's off. And even think this 4.1% that we are using to model our base case in Property MetriX is very off. And I'll tell you why. So there's something that we don't think about, and it's called inflation. And not many people understand what's happened from 2020, 2021 onwards, where the government has printed a significant amount of money and pumped that money into the economy. We were seeing for the last, from 2008 to say 2020, we saw record low interest rates of 0 to 0.5% in the UK, in the USA, which has meant that there's been a lot more money injected into the economy. And what does this mean? So you might hear terms like quantitative, easing and economic stimulation and money supply. And you wonder, what do all these terms mean? Let me just tell you in a very simple term. Inflation. Prices rise faster than they've previously been rising. Let me show you a chart, and hopefully this should make sense as to why I think this 4.1% we are forecasting as a growth multiplier for the next, say, 5-10 years or more is wrong. Okay, so let me... So this is a chart from the Federal Reserve, which is the American central bank. So they are equivalent to our Bank of England in the UK. Now, why am I showing you a chart from the USA? Why am I not showing you what's happening in the UK economy? The reason being is what happens in the US financial markets drives the global markets. So whatever you see happen to asset prices in America, the rest of the world tends to follow because they are the dominant economy in the world. So that's why I'm going to start with the USA to just give you a picture of what's happening. So this here is the M1 money supply. So what exactly is M1 money supply? As you can read here, money supply is really the stock of all the money in the system. So as you can see here, M1 consists of currency outside the US Treasury, Federal Reserve banks, and the vaults of depository institutions. Demand deposits at commercial banks, including those among held by depository institutions. So effectively, the way you can look at this is money supply is telling you what's the supply of all the dollars in circulation in the United States right now. So if we're talking about the UK money supply would be what's the sum total of all the pounds in supply in the UK economy right now. So just to kind of give you a quick summary of exactly what money supply is showing you here. So as you can see in the United States, from 1960 to 2010, the money supply was relatively consistent, very flat. Money grew from, what was this? $141 billion to $1.69 trillion in 2010. And then it's tended to rise at a faster pace, but relatively steady until 2020. Then look what happened from 2020 to 2022. Do you see that big jump? So from 1960 to 2020, there was $3.9 trillion of dollars in circulation in the US economy. But from 2020 to 2021, this jumped to about $20.7 trillion. So you understand what I mean? So more money was printed and created in the US over 2 years than the previous 60 years by a factor of 5. Do you understand what I mean? You understand how crazy this is? From 2020 to 2022, more money was created out of thin air in the US over those 2 years than was than existed in the previous 60 years. Okay? So the money supply we saw for the previous 60 years saw inflation at about 2 to 3% or so a year. So what do you think can happen to inflation when you 5 times that sum of money in the economy? Uh, you know, you don't have to be a rocket scientist to say number go up. Okay, so if we look at the UK, and I'm going to show you a chart of the UK. This is probably, I'm going to show you a chart of the, so if we look at the UK, so this is the money supply growth in the UK. So as you see here, from 2015, we was at about $2.8 trillion, and we peaked in 2022 about $3.1 trillion. That's a 50% growth in money supply in pounds in the UK over the space of about what's that, 7 years. So you could basically extrapolate to say, from about 1960 onwards, we only had 2 trillion pounds circulating in the whole UK economy. But then 7 years later, we printed half of the total supply of money we had for the previous 60 plus years. So what I'm trying to say to you is this: when you print money at this level, it leads to inflation. Prices go up faster when there's more money in circulation, because when there's more money chasing fewer goods, there is more demand than supply, price goes up, things goes up. So what I'm saying is, with this money supply, with this level of money printing and record low interest rates that we've seen over the last couple of years, I think the long run inflation going forward is going to be between 5 and 10%. To be honest, the Bank of England's 2% target they've set, that we've so-called been achieving over the last 10, 15 years, is a lie. Let's be honest, it's just a lie. Just look at your grocery shopping, just look at your shopping basket. Does it look as if the price of the things you buy each week has just gone up 2% per year? Does it look like the loaf of bread you buy has just gone up 2% per year on average? Look at your chocolate bar. I remember 10 years ago, I used to buy, you name it, Kit Kat, any chocolate bar, 50 pence, 40 pence. Now they're about £1 in the shop. So that's a, 100% increase over the last, give or take 10 years. So that would imply 10% inflation a year. As well as that, have you noticed your chocolate bar becoming smaller? What you used to pay for 4 fingers of Kit Kat, you're probably getting 2 fingers for now. So not only have you seen inflation mean the price of that chocolate bar has gone up, you've also seen shrinkflation happen, where you're getting less for your money. So that's a double inflation. So realistically, the price of that Kit Kat bar has probably gone up 300% or so over the last 10 years. And that will imply a 30% inflation a year. Think about that for a second. So I want to go back to my chart now on the modeling you saw on UK property prices, and just add some of that increased money supply impact that I think is likely to lead to a higher rate of inflation over the next, say, 10, 15, 20 years. And let's model what that looks like and how property prices might look under a much more accelerated inflation rate regime. So here we are at my model again. And let's say we said, okay, let's say we believe inflation going forward is going to be between 5 to 10%, and this is also going to be the growth rate of UK property, 5 to 10% going forward. So let's just go in the middle there at 7.5%. So if UK property was growing at 7.5% per annum, by the way, I done some data check recently, and the actual growth rate from about 1950 to 2024 was about 7.1% per annum. So this 7.5% growth rate per annum in UK property is not far-fetched. So if UK property was growing at 7.5% from 2024 onwards, the average property price in London would be 810,000 pound by 2030, 1.669 million by 2040, and 3.4 million by 2050. Now let's look at the UK average, for example. The average UK home by 2030 could cost £412,000, £848,000 by 2040, and 1.748 million by 2050. Now, if this doesn't convince you and motivate you to start buying now and to really take your purchasing decision serious right now, then I don't know what will, because I, for one, believe growth rates are going to be closer to this number because of all the money printing and all the inflation we're going to see going forward. So if you apply this growth factor to prices as they are today is like Black Friday, Boxing Day sales rolled up into one. Grab them whilst you can, because when inflation and money printing and economic growth starts to accelerate again, property growth rates are going to accelerate again, and you're going to be looking in 2030 and seeing house prices in London nearly £300,000 more expensive than they are today. House prices in the northwest being almost £115,000 more expensive than they are today. So as a growth factor, if we did see that 7.5% growth rate on UK properties a year, property prices are going to be 54% higher in 2030 than they are today. So take advantage of the prices you see today. Do not fear the slowdown in markets right now. Do not listen to the news and the media and your friend telling you, don't buy, wait, rates are high, all these other silly things they say. Buy now, because over the long run, UK property prices increase. And my bet and our base position in Property MetriX is that UK property prices are going to increase at a much more accelerated rate over the next 5, 10, 15, 20 years than they have for the previous 5 to 10 years, because of all the money printing, monetary growth, inflation and all that. So you add in an accelerated growth rate onto UK property, and it's not long before the average first-time buyer may not be able to get on the property ladder or buy one of these homes. Let me also say something interesting to you. This doesn't mean the average first-time buyer won't be able to buy a home. No. And I want to introduce you to the concept of shrinkflation. I'm going to make a much more extensive video on this for you. What do you think is going to happen as the average UK property becomes more expensive? It's going to lead to shrinkflation. Remember the example I said to you with the chocolate bars? That the price of a 2-bar Kit Kat today is the price of what you could have got a 4-bar Kit Kat for about 10 years ago. Because what they've done is, to stop the price from running away, they've given you less for the same money. Does that make sense? So you may not think the price has increased a lot on nominal value, but actually when you think about it, that if you had £1, you could buy about, say, 2 bars of Kit Kat 10 years ago, and there were 2 4-bar Kit Kats. Now with your £1, you can only buy 1 Kit Kat bar, and it's going to be most likely a 2-bar Kit Kat. So you think about that. So not only is that £1 now buying you less, you're now getting less in the packaging. So effectively the inflation rate is a compound inflation rate, which is double the rate on what you thought it was. So it's double the rate of expense on what you thought it was. I know that concept might take a bit of time to get your head around, I know that concept might take a bit of time to kind of really wrap your head around it, but just I want you to do me something, do a challenge for me. Go and look at all the things you buy, your favorite, your favorite drink, the things in your shopping basket, and look at the sizes of what you're buying versus what you used to get, and think to yourself, am I not getting less in this packaging than what I used to get 5, 10 years ago, but paying more? This is called shrinkflation. And the same thing has happened to property. Have you seen some of those 1900s Victorian conversion properties in London, in Scotland, and stuff like that, where you're seeing this tenement building or this house being converted into 2 levels, 4 levels? Remember, in 1900s, this was one house. This was sold as one home. The person owned all of it, the top and the bottom. So, and they were probably paying £100,000 for the house back then, maybe even less. But look at now. You've got your average Victorian conversion in London might be going for 500,000 and you're getting half of a house. So if you think about it, the whole house would be worth £1 million today. Versus the person who bought it back in the Victorian times, or even as early as maybe even 30, 40 years ago, would have probably paid, 100,000 maximum for it, and you're now paying 500,000, so effectively 5 times more for half a house. Do you understand that concept? This is the concept of shrinkflation. So that's what's going to happen as UK properties continue to increase. As the average property in London goes from £525,000 to £1 million, what's going to happen is, to keep the average prices affordable, they're going to do more home conversions. So right now, you might be able to buy a 3-bedroom house in London for £500,600,000, but by 2030, you're probably going to find that shrinking to a 2-bedroom house. By 2040, you're going to find your £500,000 shrinking can only buy you a 1-bedroom home, until it gets to the point where we're in a similar situation to, I don't know if you've seen Seoul in South Korea and seen the flats they sell there. They're really tiny. Like, you're looking at 2 to 3 bedroom apartment being the size of maybe your standard 1 bedroom in the UK by square footage, because of shrinkflation. So that's what you'll start seeing. You'll start seeing that you're going to be spending more for property in the UK and get a lot less in square footage than you can today, because that's the only way how the government, because that's the only way how property prices can be kept affordable, if you apply shrinkflation. So right now, take advantage when you can buy an actual complete home for the prices you can today, because 5, 10, 15 years from now, it's very likely you're going to be spending more money and getting a fraction of the property you used to be able to buy for your money. Hope you enjoyed that video. Hope that added a ton of value to you, and I'll catch you on the next one.